From the management side today, we have their MD, Mr. Sandeep Kumar sir, and CFO, Mr. Sen Gupta sir. Joining us today is also Mr. Sandeep Agrawal, Head Investor Relations, Tata Steel Group. So without taking much time, I'll hand over the call to Sandeep sir for the opening remarks. Thank you, and over to you, Sandeep sir.
Yeah, thank you, Sahil. Thank you, everybody, for joining in. Well, the Q1 performance of Tata Metaliks has been a stupendous one, considering that Q1 was a COVID quarter and the second wave of COVID was at its peak. So we had an impact on demand everywhere, whether it was the pig iron business or the ductile iron pipe business. However, there was a silver lining, and that was a powerful one, which is in the form of strong pig iron prices. And I think that helped us in lifting the profitability significantly. Of course, there was another one, which is the record sales volumes of pig iron, which was primarily led by exports, in the sense that usually our exports of pig iron is limited to 4-5%, but this quarter we could move it to 25%. So primarily these two reasons for the jump in profitability. One is the prices, and actually there has been an increase in raw material prices as well, but I think we will see the impact of that coming in from next quarter, rather from Q2 onwards. As far as Q1 is concerned, the spreads of pig iron have been the highest ever. The sales volume have been the highest ever. So both these factors, it's primarily the PI business that's showing the profitability. As far as the ductile iron pipe business is concerned, Q1 is traditionally a weaker quarter because the fund flow, the projects get approved, the fund flow starts happening. So it takes a bit of time because the government approvals happen, and especially after a very, very strong Q4, typically the Q1 is a weaker one. So that's one factor for a slight, I would say, muted performance of ductile iron pipe. And the second reason, of course, is COVID, especially the restrictions imposed in the state of West Bengal by the government of restricting the workforce to 50%, which meant we could not operate all our lines. So we were operating at, let's say, about 60 to 70% of the capacity, and that resulted in lower production. But as far as our demand is concerned, or the books are concerned, that's very, very healthy. And if the workforce restrictions had not been there, we would have done much better in the ductile iron pipe segment as well. The one factor where it continues to be low, and it may continue in Q2 as well, is the price of ductile iron pipe. Because we had a good order load last year, which we, towards the end of last year, when we booked a very good order load, while it gave us comfort, stability, and continuity of supply of sales, what it didn't help us was that we're not able to take advantage of the change in prices that we have seen over the last few months in the ductile iron pipe business. So the DI pipe business has seen an increase in prices of almost 25 to 30% compared to, say, last year. And the results of that will start getting reflected in the latter part of this year. Q1, we continue on the old prices. Even Q2, there will be maybe a marginal increase or maybe similar. And maybe Q3, there could be some improvement. And Q4 onwards, we'll start seeing some jump there. So all in all, despite the muted performance of DI pipes, which is primarily because of, as I said, workforce restrictions, otherwise the DI pipe business has also done extremely well, considering it's a weak quarter. We've had a fantastic performance in Q1 in terms of profitability, in terms of sales volumes, and most importantly, costs. I think we have been able to control our costs pretty well, and the operating figures that we normally don't discuss in these investors and media calls are very, very good, and they give us the confidence that going forward, we will be able to sustain these. So that's, in summary, the performance. In the numbers, I presume you already have it, but if I could just kind of summarize them, the sales of pig iron were about close to 90,000 tons compared to, let's say, 80,000 tons in the previous quarter. The ductile iron pipe sales were about 50,000 tons, which was a drop compared to 75,000 tons in quarter 4. And I've explained you the reasons why. Profit before tax was 135 crores compared to 124 crores in the previous quarter, and which is a 9% jump. And PAT, profit after tax, is a 26% growth at 95 crores versus 75 crores in the previous quarter. EBITDA margins have been at 26% compared to 22% in the previous quarter. Actually, the best way to compare is year on year, but because the quarter 1 of last year was a washout due to COVID, we are not comparing, we're not making that comparison. We are doing a sequential quarter comparison, but DI pipe business is a seasonal business, so it's not a fair comparison, but still you will find that the numbers are quite good and helped by the market. Also, due to our cost controls and operational improvements, overall the performance has been, I would call it excellent, and I hope we can carry this forward into the rest of the year. I'm through with the summary. 𝐥𝐤𝐬, you want to add anything?
No, sir. We have covered all. You can go to the question and answer session.
Okay. So then we are through with a brief on the overall performance, and we will be open to comments and critiques and question answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question, please press star and 1 now. The first question is from the line of Dhaval Doshi from Sundaram Mutual Fund. Please go ahead.
Yeah, good afternoon, gentlemen, and thanks for the opportunity. So just wanted to know the near-term outlook in terms of, post the lockdowns open up, how is the trend as of now? And what kind of a price increase we can expect in ductile pipe since it was contracted, as you mentioned. So we can expect in, second half of the year, if we can, give some sense on that in terms of the trend, and what kind of, cost escalations which we are looking at in terms of increase because of the increase in coking coal as well as iron ore price.
Right. So if I got your question right, you want to know the raw material cost impact, you want to know how much is the price increase going to be, and what was the first part?
How is the trend now? Post-lockdown opens up, in the month of June, July wise.
Okay. So on the market front, on the outlook, the markets have been pretty steady of pig iron. There has been the usual volatility, a little bit of up and down. You see, the quarter 1, actually the demand in the foundries had come down to almost 30-40% because there was no labor, or rather shortage of labor, then COVID restrictions in many states, and they also faced problems of working capital, etc. So there were issues, and the demand wasn't there actually. But because we exported, we were able to manage the sales deliveries. As far as the prices were concerned, the prices have been, it's a commodity boom, so it's basically taking that path. Okay. Now that continues into quarter 2. There isn't much of a change. Yes, there would be some ups and downs. Now, for example, yesterday we increased, prices of our pig iron in East, by let's say 800 to 1,000 rupees. Okay. But previous week, the prices had fallen by 500 to 1,000 rupees. So that kind of a weekly change up and down will continue to happen. But by and large, the prices continue to be strong. That's one. Secondly, the foundries are coming back. The foundry clusters, whether it's in Howrah, whether it's in Ahmedabad, whether it's in Delhi or Punjab or wherever, the foundry clusters are coming back strongly. from 30 to 40% capacity utilization. Now they are at almost 60-70%. Some have even touched 80. So the demand pull is going to happen on the back of auto, agriculture, and engineering product offtake. So that's happening. That's beginning to happen. We can see that. So pig iron business is therefore still looking strong. As far as ductile iron pipe is concerned, that's really taking off, and you haven't yet seen much of it, but that will really move into a different horizon over the next few quarters. And why I say that, I just in fact mentioned in the morning in this interview as well. Typically the supplies of ductile iron pipe is about 1.6 to 1.8 million tons per annum. And why I say it's at this level is because last 2 years, because of the COVID, the volumes haven't taken off. Otherwise, traditionally, the ductile iron pipe business has grown at a rate of about 9-10% per annum over the last 5 years. Okay. But what we are seeing is that 1.7 million tons of orders are already there with different producers as on date. And about 1.5 million tons of inquiries are there in the market. So that makes it about 3.2 million tons. In addition to that, we have schemes and which are announced or being announced for a volume which is another, let's say, 2.2 million. So we are close to 5.5 million tons of DI pipe order visibility, which is typically a 3 years order load. So that's a fantastic visibility. Typically, we get a visibility of 18 months to 24 months. Now what we are getting is almost 3 years. So DI pipe will, I think, just go through the roof unless something drastic happens. And it's an industry where there are heavy entry barriers. It's not like some other industry where people can come in. Like, for example, you want to make billets, people can come in, secondary steel players can come in. But in ductile iron pipe business, it's extremely difficult to get in, both on the technical front and marketing front. So those entry barriers will ensure that the existing players have an advantage, which is going to continue for some time. And I think this demand-supply gap is really going to move the prices up. We've already seen the price movement up by almost 25-30% compared to, let's say, Q3 of last year. And so if the prices were, let's say, close to 50,000 rupees per ton of DI pipe on an average, then now we are already seeing upwards of 60, more like 63, 64,000. So that price movement has already happened, but this is for new orders, which will get executed, let's say, over the next few quarters. So the price reflection in our net realizations and in our earnings would not be visible to you maybe until a quarter or two. Okay? So that's the difference. So that's where, as far as cost is concerned, I was mentioning about the spreads. The PI spreads, the pig iron spreads have been at an all-time high of upwards of 18,000 rupees per ton. They usually have been in the range of 5,000 to 6,000 per ton if you look at the average of last 5 years. Last quarter, it was at about 15,000 rupees. So it's kind of, 3 times the normal level. Now, this is a level which is not sustainable and therefore will come down. Now, whether it will come down to 14, 15, 13, 12 is something for us to see. For Tata Metaliks, I think the cost control and the benefits of cost have been going up, especially over the last 2 years. I think, I don't know whether I mentioned to you, we shaved off almost about 80 to 90 crores, close to 100 crores of costs last year through improvements in our fuel rates and PCI and operational controls. Now, end of this year, the financial year, FY21, we commissioned our 4th power plant, and that's a 15 megawatt power plant, and we also expanded our coke ovens. Right. Both these are going to give us major advantage in our costs. So I think despite the spreads coming down, or let's say despite the raw material prices going up, we should not be impacted to the same level as maybe some others, because we are improving greatly on cost and cost front, and that is something which is sustainable. So that's the overall picture. I don't know whether I fully answered your question.
Covered. Yeah, covered. Thanks, sir. Thanks.
Right.
Thanks.
Thank you. The next question is from the line of Falguni Datta from Jefferies Securities. Please go ahead.
Yeah, good evening, sir. Sir, I just had one question on this. Given that coking coal costs have doubled, so taking into account this coke oven expansion that is coming in, what do you see the per ton impact just on account of this coking coal from Q2 and Q3?
Okay, right. 𝐦𝐤𝐤𝐤, you want to take that?
Yeah, I can try. So the coking coal, April and May, it was moderate, around FOB $105. But in the month of June, it has moved, and currently it is $210 FOB Australia. So that will definitely have an impact. However, if you see that market coke price was higher, much higher in last 10 to 12 months, and a lot of competition, they are buying coke from the market. In our case, definitely the cost will go up, but over the period, over the last 3-4 years, we have improved upon on the coal blend, and we can use to some extent inferior coal or second-run coal for the coke oven and to make good coke. That will keep our cost contained. But definitely the $105 was aberration kind of thing. In long time average, we have seen that it is run between 160 to 240 kind of dollar. So that is fine. So that impact will be there, but that will be definitely it will be also impact what in this was saying in Ganga, and also in that bacterial pipe and to some extent other people.
Sir, can you just quantify broad range of per ton impact, a broad range that this will have? So given the mix that you are using also.
So if you see that coke price, if the coke price goes up by say $5,000 rupees per ton, and your coke net coke is say 480 to 500 net of PCI, then it will be 2,500 kind of number per ton can be. Right.
You mean to say that this doubling of this coking coal prices will just have an impact of 2,500 per ton?
Per ton of hot metal.
Yeah.
Because,
okay.
Over the period, we have increased the PCI rate, which from the last year, from the FY20 68 kg per ton of hot metal, we have improved up to 116, 117. So that helps a lot, and our exposure to coke is comparatively lower, and the coal and the PCI coal is much cheaper than the main coal or hard coking coal and corresponding the coke price.
Okay. Okay. Thank you, sir.
So if I can just attempt to kind of summarize it or add to that, there are 2 or 3 levers to counter it. One is the leaner coal blend, which 𝐦𝐤𝐤 talked about. Second is the additional coke, captive coke that we are now getting. Compared to the market coke, the captive coke is still much cheaper, although the gap has come down. And the third is the captive power plant, the 4th power plant. So these are the 3 ways in which we'll be able to retain our cost competitiveness, despite there being an increase in, let's say, the raw material prices. Okay. And therefore, the spread for us may not be as bad as maybe for somebody else. But there definitely the spreads will get compressed to some extent. The question is whether it comes down from 18,000 to 16 or 15 or 14. That's what we'll have to see. But still, compared to what you see on an average 5,000 to 6,000 rupees over the last few years, it's still at a very, very healthy level.
Okay, and so this 18,000 coming to 14 will also broadly, I'm saying, will also include the increase in iron ore prices. I mean, you would have taken that in. I mean, if you could just quantify how much would that impact the margins, the iron ore cost increase?
No. So this spread we take it from between coke and pig iron. We don't include iron ore. So iron ore has been increasing. Iron ore has already increased. If you look at it in Q1 this year, there has been a major jump. But as of last week, the iron ore prices in Odisha, they fell in the latest auction. So we'll have to see how much of it actually happened. So they fell, let's say, almost by about 2,000 rupees in one of the indices. The other one, of course, fell by more like 500,000 rupees. So it's still a little bit unclear as to how much will be the impact of iron ore, because it went up in Q1 already, and it seems to be coming down a little bit in Q2 in the first 10 days that we have seen. So we'll have to see how much it goes. But coal is very...
You mean to see from between Q2 and compared to Q1, we won't have an increase in iron ore if we compare Q2 with Q1?
Correct.
Okay.
That's exactly what I'm saying. That Q2 may actually be lower in iron ore. But as of now, this is early days. It's just 10 days in July. So we're not coming to any conclusion, but just mentioning to you that we need to keep that into account. Iron ore had already moved. It reached to a record level internationally also at about $223.
Yeah.
So it's come down from there, so maybe more like 210 or something, both internationally and domestically. Okay. Right.
Thank you, sir. That's all from my side.
Thanks.
A reminder to the participants, anyone who wishes to ask a question, please press star and 1 now. The next question is from the line of Nalin Shah from NVS Brokerage. Please go ahead.
At the outset, I must congratulate the management for the stupendous performance which you have shown for the Q1. I have two questions. One is that what is the size of top line which will increase post this expansion, addition of another 2 lakh tons or 2,20,000 tons, which is expected to go on stream by the end of this financial year last quarter of this financial year. That is first. And secondly, what is the synergistic, what you call the cost reductions or profit margin improvements we are looking at from the merger between Tata Long Products and Tata Metaliks? If you can quantify that also.
Yeah. So thank you very much for your kind comments. The second one you said is merger, and the first one you said is what?
This is that addition. What is the the top line which increased by how much based on that 2 lakh ton expansion?
Yeah. Correct. So if you look at our business currently, we have a turnover of, let's say, about 2,000 crore. I mean, this year will be up because the prices are up. But if you look at it on an average over the last 3 years, it's been at 2,000 crore top line.
Okay.
Now, if we assume that as the normal, and we don't consider the increase that has happened, let's say, in the last 6 months to 9 months, then going by that same logic, if, the 2,000 crore will become 3,000 crore.
Okay.
Why?
Okay.
Because the pig iron business and the ductile iron pipe business are almost equally split in terms of the top line. So 1,000 crore, 1,000 crore. And we will add another 1,000 crore in DI pipe. So that will make it 3,000.
Excellent.
Of course, if we take into account the price factor, etc., that may go up to 3.5 to 4. That's a different thing.
Correct.
So how much of that is sustainable, I don't know. But DI pipe, of course, the prices to me look very, very strong, and they may actually be more sustainable than the pig iron price.
Excellent.
And as far as merger is concerned, I think we will let you know closer to the date as to how much is the quantification, etc. But generally speaking, the merger benefits are more on the upstream side, more on the cost front, and things like the blast furnace, sinter plant, coke plant, pellet plant, iron ore mine of Tata Steel Long Products. All of that is going to be beneficial to Tata Metaliks. Particularly, I said the iron ore mine and the coke plant, because we are still short of coke by about 20%.
Correct.
So we can take it from them at cost. We can pick up iron ore at cost. So that's going to be straight a benefit for us, number one. And number two is that, generally sharing of resources, stores, spares, raw material. I think all of that will all hit the bottom line in some way or the other. Then, of course, there are the typical normal synergies of shared services, corporate services, functions like HR, accounts, finance, all of that. You can rationalize all that. So there would be synergies on all these.
Correct.
As far as downstream is concerned, we have different downstream, businesses. So I wouldn't really think there would be a great amount of synergy there, but there would be some amount of, sales, networks and etc., where there could be some synergies. But most of the synergies are upstream. Most of the synergies are in shared services, raw material front, And we haven't really quantified that at the moment in terms of trying to and explain that to you. But we have some internal figures, but we will share that with you once we are closer to the merger date, actual merger.
Yeah. Are you expecting, merger timelines? Because I'm aware that because of this, the COVID-19, the hearing, etc., are getting delayed. But any, this thing you have internally in mind that based on whatever, the progress has happened, that by, let's say, by September, by November, December, when you expect this to be over?
See, the merger process has got delayed because of the regulatory approvals, that we applied in November. We were expecting the first stage to be cleared within a month or two. That's taken time. I think that's something which has already taken over 6 months. So I would think but from that logic, we are delayed by almost 6 months.
Okay.
But how much more we are trying to do it faster? But, it all depends on the regulatory approvals. So my sense is that it may take maybe another 6 to 9 months.
Okay.
All depending on how the regulatory approvals come through. If they come through faster, because of COVID, things got delayed.
Yeah, right.
But as we go forward, maybe things might happen faster.
Okay.
But a lot of it is dependent on the regulatory approvals, and that takes its own time.
Yeah.
So it's a little tough to really give you an exact date, but possibly 6 to 9 months. Possibly.
Fine. So, in short, we can say that before the end of the financial year, it will happen definitely.
Will is a difficult term to quantify, but let's hope so.
Sure. Thank you very much, and once again, I must congratulate for a wonderful performance.
Thank you very much.
Thank you. The next question is from the line of Arjun Pathak from Centra Advisors. Please go ahead.
Good afternoon, everyone. Congrats for the great numbers and thank you for the opportunity. So, as per my knowledge, the DI pipes realization are fixed through short-term contracts. So, do these net sales realization are related to the global steel cycle or the global steel prices? To sum it up, what I wanted to know is that does the element of volatility exist in the net sales realization for the DI pipes?
So the DI pipe business is not connected to the steel business directly. Indirectly, everything is connected, but not directly. The pig iron business is more aligned to that, to the commodities, prices. What happens is that, look, realistically speaking, it's the demand and supply which determines the prices. Speaking. And there is, of course, the cost push, which is the raw materials. What is happening is, in the steel sector is that there is a demand pull and there is a cost push, and which is what has led to this, boom. In the case of ductile iron pipe, the demand last year, because of COVID and because it is dependent on the government funding for water infrastructure, and the funding got diverted towards COVID relief, the fund slowed down, and therefore the deliveries and the real demand, on paper you had demand, but the real demand wasn't there, and that's why last year the performance of the DI pipe players wasn't all that great. In fact, it shrunk compared to the previous year. But with the government coming out with its schemes on 𝐥𝐤𝐤𝐿 mission and its ambition to really transform the water sector with the amalgamation of different water ministries, what is happening is that we are finding a great push on the water sector, and that's reflected in the inquiries, in the orders, and in the new schemes that are coming up. And that's exactly what I was explaining a little while back. And this demand does not seem to have enough supplies. And therefore, my sense is that the prices will simply zoom up. So while you have seen that zooming up of prices on steel and other commodities, you haven't seen that in ductile iron pipe, which in any case happens with a lag, because all of it impacts each other. But this one is not going to be impacted merely by the commodities boom, but by a fundamental, demand-supply mismatch, which is going to continue for the next several years. So that's where I think the DI pipe business appears to be very, very attractive, and the existing players seem to have, an entrenched competitive advantage because of the high entry barriers that you find for anybody else to come. It's not easy to come and set up a DI pipe plant. In fact, the existing players also have suffered, many of them, because it's a difficult business to be in. So I think that's what the outlook. To me, the outlook for the DI pipe business is extremely strong.
Right. Got it. Thank you. And another thing I wanted to confirm, these spreads which you provided earlier of around 18,000, those are the EBITDA numbers, right? EBITDA per ton?
No. The spreads are simply the pig iron price minus the coke price.
Okay. So can you provide the EBITDA for the DI pipes?
Yeah. So we had see what we do is, if you look at our EBITDA numbers that we give it out in the press release, etc., there it is a transfer price. So the DI pipe business is an independent business unit. It buys hot metal from the pig iron business, and therefore the EBITDA numbers there can be somewhat misleading. So what we also started giving you is the EBITDA numbers for DI pipe from the raw material stage. And if you look at that, the EBITDA margins typically have always been about 20% for DI pipe, and this quarter has been, in fact, about 30%. If I look at it from raw material to that. But if I look at it from a transfer pricing perspective, then the EBITDA is only 5 to 6%.
Okay, got it. And just last question, can you tell us about the integration levels, like the iron ore you procure from Tata Steel, right? But what would be the prices? Would it be similar to the market prices or at a concessional price?
So it is linked to the market price, but obviously we get a long-term discount because it's a subsidiary company, and although it's at an arm's length, because it's for a long-term contract, whatever you will get in the market, you will get something similar. So we do get it at a slight advantage to the market. The more important point is, more than the price, it's the quality of material that you get from Tata Steel mines. That makes a lot of impact. So that's far more consistent, and we know what we are going to get it. When you buy from different players, every time you might get a different quality. So that makes a major difference.
Okay, right. Thank you so much. Thank you so much for answering that.
Thank you.
Thank you. The next question is from the line of 𝐥𝐤𝐤𝐿 from Centrum Broking. Please go ahead.
Yeah, hi. Thanks for the opportunity. So 2 quick questions on macro. One is, what's your view of iron ore prices domestically, given the fact that 2 of the mines are maybe going out of the market in August?
Ashish, your voice is not clear. You need to come closer to the mic and speak more clearly, please.
I had 2 questions actually. One is on iron ore. So what's your view on domestic iron ore prices, given the fact that 2 of the mines in Odisha is going out of the market maybe in August? And secondly, is it possible to share your view on coking coal prices, why it has shot up? Is it supply issue or some kind of demand improvement which we have seen?
Right. I will request Subhro Sengupta to answer. He also handles the raw materials. Subhro?
Sure.
Yeah. So I don't know. Our view or my view is that it has peaked. If it goes further up, the downstream industries will start getting shut down, kind of thing. And if you see, there are a lot of representations from the various manufacturers association of Odisha and Chhattisgarh are going to government. So I think they just peaked and it will be stable or it will come down a little bit. On coking coal, I think that we used to be happy to have that $100 kind of number. But again, the long-term numbers was 160 to 240, which are average of 200. So, and there is a huge beef going on between Australia and China. And there is a $80 kind of arbitrage between the Australian coal to India and Australian coal to China. So, if the differences between Australia and China is sorted out, definitely the price may go up rather than come down. But I think $200 is a fair price based on the long-term average. And if it remains at that level, we'll be continue to happy.
That's okay, sir. But my question was that what has changed in last 2 months which led to that sharp increase? Because the tension between China and Australia still continues, and world ex-China production has not increased.
So there are, in the beginning of the month, some of the traders were taking position. As the steel prices are very high in India, a lot of closed units have started opening. And also from the supplier side, there are some restrictions in the quantity. And people, those who have got that opportunity and got the cash, they wanted to buy more to keep it on stock. So both on the demand side, it has gone up, and there was some restriction in the supply side. Both together, it has come to that level. But the increase was very sharp. In 1 month, it has become double. But I think that number will be sustained at least for 3-4 months.
Okay. So our view is that coking coal price will sustain at this level for some time.
Yeah. And the iron ore price, it was picked up and may come down slowly. It should not increase further.
Agree. But given the fact that, our demand is somewhat low, especially in this weak season, don't you expect a sharp correction in domestic iron ore prices?
May not be, because, after the changes of the amendment of the NMDR Act, effective 28th March, the royalty structure has got changed. Earlier, the OMC, NMDC, they used to pay 19.8%. Now it has become 42.3%. So that 22.5% increase, in any case, it will go up. So we don't expect any sharp decrease because there is a change in the tax structure and duty structure. But the decrease could be there, but it will be slow decrease.
If I can just add a couple of things here, I think to answer Ashish's question. If you look at Odisha, last year the auctions had happened, if you remember, in March for the leases which had expired in last year. So total capacity of Odisha is about 150 million tons, out of which, after the reallocation of mines, 70 million tons is captive, which was earlier 40. So 40 went up to 70, right? And merchant came down to 80. So if the merchant capacity has come down to 80 million tons, so from let's say 110, and captive went up from 40 to 70. So 30 million tons moved out of merchant to captive. Okay. Now out of this merchant capacity of 80 million tons, the current production, if you look at Q1, is 15 million tons, which means on an annualized basis, it's 60 million tons. So Odisha is short of 20 million tons of iron ore production on an annualized basis, if we just compare. So that's where the shortfall is also hitting the market. However, there is, the private mine, the Steel Authority of India was asked to release its material in the marketplace. That helped matters to some extent. But alongside, you had international prices which, zoomed into, let's say, the highest ever. So these factors have kept the iron ore prices high. But as the restrictions, or let's say as the bottlenecks in iron ore production in Odisha get relaxed, they get eased out, you will have higher production coming out, and therefore to some extent the iron ore prices may ease out. We have seen some amount, the reduction of almost about 500 to 1,000 rupees per ton in last week's auction of OMC. We might see a bit more, but what Shubhro's point is, because of the royalty going up, things may not be as easy as it appears. But I think primarily demand supply will dictate, and as far as demand supply is concerned, there's clearly a gap of 20 million tons on an annualized basis. As far as coal is concerned, the coking coal prices were artificially low at about $100 to $110, while the prices into China were almost about $80 higher. China was buying from Canada, US, Mongolia, Indonesia, etc., while India was buying from Australia. Okay, because Australia was not selling to China, or rather China was not buying from Australia. So this is a political standoff, And this happened after September or October last year. And you saw a sharp deviation in the prices which were going into China and into the rest of the world. That deviation and that arbitrage of almost $80 continues till today. So even though the coking coal prices have moved up from, let's say, 110 to 200 or 210, the Chinese prices have also moved up to $280 to $300. Why it has happened? It's happened primarily because of two reasons. One is the demand. The steel demand is booming. So obviously there is a demand for more coking coal. China is producing like nobody's business, so it's sucking up the coal from other countries, and same thing, that's reflected ultimately in the prices from Australia into India and other places. That's one factor. Second is there have been some issues, production constraints in Australia of coking coal, and what Shubhra mentioned about some traders taking positions, etc. But I think primarily these are the two reasons. Ashish, I don't know whether I could answer your question.
I think, sir, you have mentioned it clearly, but my only submission was that the factors between China and Australia that has been there for last 8-9 months, and world ex-China production, if we look at, that has been somewhat flattish in last 3 months also. So, this all of a sudden jump, one factor which you mentioned about traders taking position, that can be possible. But if that is the case, I don't know whether it's sustainable at 210 or not. Because until and unless China and Australia tension erases, it becomes difficult for coking coal to sustain at this level for long. That's my thought.
Right. So I think it's very hard to predict prices for anybody. People have different views. What will come out is very difficult to say. But these are some of the fundamental reasons for why the prices are, even for that matter, I don't know, Brazilian mines had some problems. So one of its major facilities, its slime dam safety issues were there. So it had to suspend production for some time. So similarly in Australia, coking coal mines, there was some suspension of coal production in some places. So all these factors together contribute. But primarily when there is a steel demand, every other raw material is going up. Why would coal not go up? That's my fundamental question. Isn't it? If iron ore went up from $88, $90 a year back, or in March 2020 to $220, $225, coke has gone up, steel has gone up, coal had to go up. And the arbitrage still continues to be $80. Okay? So I think that's perhaps some way of explaining that.
Sure. Thanks for this question.
Right, Ashish. Thank you.
Thank you. The next question is from the line of Udit Sharma from Investing Hut. Please go ahead.
Hello, sir. Congratulations for talking strong set of numbers. I'm really happy after seeing the numbers. Most of my questions are already answered. You have explained very detailed, so I got the answers. I have only two quick questions. As I heard the last few conf calls, so I know that the company focuses toward ductile iron pipes. So as you have already explained that, post the capex, we used to clock 3,000 crore as a revenue, and out of that, 2,000 crore will go to ductile iron pipe. So, if we do the split, then it's 70-30 ratio. So just as a ballpark number, I want to ask what is the aspirational margin target for ductile iron pipes? I know that right now the situation is very challenging, but from future perspective, what is the aspirational margin target for ductile iron pipe business?
So at any point in time, in ductile iron pipe, we have on an average made about 20% margins. Okay? If you look at the history, you will find on most occasions, on most quarters, we would have made roughly about 20% plus. And this quarter has been exceptional because PI has gone up, significantly, while the lag effect on the DI pipe prices continues. But as I said, there is a fundamental change which is happening in the ductile iron pipe business, and that's the demand-supply mismatch, with demand just booming like nobody's business because of the tremendous investment by the government of India. As against an investment of, let's say, 20,000, 25,000 crore per annum on the water infrastructure sector, the announced investments are, upwards of 70, 80,000 crore. Now, assuming that 50% of that comes in, we are still double of what has happened in the past. Where is the new supply? Okay, so the demand-supply mismatch will really push up the prices of DI pipe. What we have seen today, already a 30% increase in DI pipe prices, and that's primarily not because of the demand-supply mismatch. That's primarily because of the effect of pig iron, raw material cost push, etc., etc. Now, when the demand-supply mismatch starts playing out, I would tend to think that the prices are going to go up further. So today we are at about 60 to 65,000 rupees per ton, which was, let's say, about 48 to 50,000 1 year back. I would not be surprised if it crosses 70 sooner than later.
Okay. So thank you for it. One more question. Can you please put some light on the order book in ductile iron pipes? I mean, how much order we have in our bucket? I mean, is there any improvement from last quarter, or like it is the same what we have in the last quarter?
Actually, there has been a deterioration in the order book, and that's purposely done. We had about 16 to 18 months order books as of the last quarter. What we have done is we have tried to slow down because these are all at old prices. Last year when the situation on ductile iron pipe business was bad, we accumulated orders. And now we find that the prices are moving up, so it makes sense not to rush, because we will start seeing stronger prices in the coming quarters, and therefore we are going slow in terms of order books. Today our order books are more like 14 months plus.
Okay. So when we talk about new contracts, so like we have slowed down because the old contract price was low. Now when we take the new contract, we'll go on with the higher prices, right? So that will in turn increase the margins in ductile iron pipes.
Absolutely. But you will see the reflection of this more in the second half and towards the end of the year, because the older contracts still need to be executed, and we would like to honor all our contracts. We don't want to, like some of the players have started kind of cancelling orders. We are not doing that.
Yeah, so pandemic is a kind of, special kind of situation. So once things will stabilize, we can take a ballpark number as 20% in margins, and might be it will go up, right? That is what I am considering while calculating the numbers for future.
Yes, absolutely. I think 20% plus is a very reasonable number to take. In fact, I would think it will go up.
Sure. Thank you so much, sir.
Yeah, right.
Once again, congratulations for a good number.
Thank you very much.
All the best. Bye.
Yeah.
Thank you. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah. Namaskar, sir, and thank you for a very comprehensive discussion on various parts of the story. Sir, firstly, if we come to this DI pipe pricing, as being informed, it is now currently ruling in the 63,000 band. Sir, definitely it is all funded by the end buyer is the government. So in this case, how is the finances of government going to play out? Have they factored in this escalation of 30% going forward, or how is this math going to work going forward, since it is going to put pressure on the government finances?
Yeah. Thank you. First of all, thank you for your kind words. I think you are very right. It's a very intelligent question, and I don't have an answer to that. Yes, you are right. The government may not necessarily have considered or factored this. Nobody considers, the prices to jump by, 30-40% in a year's time. So we've already seen a jump of 30% compared to last year. But this year, as new projects, schemes are being made and announced, I would imagine that they would start building it, these things. And I would also think that, some of these projects will get slowed down. So what they've announced, let's say, for the next 5 years may actually get executed over the next 7 years. Because from where do you supply? You must appreciate that India is one of the most cost competitive DI pipe players, even better than China, because we see that in the export market. Okay? And US and Europe are just not competitive. And there are no other major players around the world. So we supply to as much as South America and Africa and everywhere, to Singapore, to Hong Kong, to every part of the world. Okay? So the point is that you don't have enough DI pipes in the world to come into India. China could have been the only place from where it could have come, but their costs are also gone up, and they have various restrictions. In any case, there is an anti-dumping duty on Chinese. So I don't think their supply is going to come from anywhere. I don't think the government will have too many options. but to budget in for the increased prices. And these prices are also a reflection of the higher raw material input costs, which all of us are facing. But we'll have to see how it goes. So there are no easy answers to your question.
Right. Sir, you told about this 1.7 million ton is the overall capacity in the country. So in the pecking order, sir, can you confirm, give an idea of which companies having what installed capacity or a nameplate capacity out of 1.7 million? The active players?
Yeah, sure. That's not a problem. So between Electrosteel, Srikalahasti and Jindal, they control almost about, let's say, 50% of the capacity. On almost equal. Electrosteel is a little bit more between Electrosteel and Srikalahasti. If you want the exact numbers, Jindal has a nameplate capacity of, I think, 5 lakh tons. Between Electrosteel and Srikalahasti, they have maybe closer to 5.5, 6 lakhs. And the total capacity, installed capacity in the country would be more like 2.4 million, but production is more like 1.7, 1.8. There are players who've actually, gone into more like bankruptcy cases, or they have been under very bad conditions financially. So they have not been able to produce in the same way. I would imagine that maybe all of them will see better times and perhaps start producing more. So the production capacity is 2.4. Actual production, if you see, is not more than 1.7 or 1.8. This might go up, plus a few more capacities like ours and Srikalahasti, etc., will come up. So as the demand moves up, the capacity will move up, but new players to come and establish themselves will really take some time.
Because I think Vedanta will also be a very strong contender with Electrosteel steel acquisition. They are also having some nameplate capacity in DIP, and they are expanding as informed in the press, since it is not a listed entity. So they will also be a strong contender.
So they are already included in this 2.4.
Included in the 2.4. Yeah. Sir, two small questions. Sir, for this year, what would be our production and the deliverables for the DI pipe? So last year we did 194, I think so, if I'm not wrong, for FY21. So for this year, sir, what should be the deliverables?
So the deliveries, typically in H1, we do about 45%, and in H2 we do about 55%. So you can calculate. We should definitely do above, 2 lakhs. We've already done 50. And maybe upwards of 220 is a more likely scenario. It all depends on how COVID plays out. But otherwise, we have done, we have achieved this number before. Capacity hasn't gone up. So we are definitely in the zone of 220 plus, but depends on COVID. Like the first quarter, we could have done more than 50, but the production got impacted due to the workforce restrictions by the government. So we'll have to see how it goes. But definitely 2 lakh 20 is a number which should be easily achievable if things go right.
Sir, in the raw material basket mix, sir, for preparation of DI pipe, what should be the constituent in percentage terms? Sir, suppose you are a player who have iron ore and the coke back-to-back arrangement. Other players who are not aligned to it, if you could give the mix in the raw material basket in percentage terms for the DI pipe production, that would be very helpful.
Okay. Shubhro, you want to take that?
Yeah, I will do. So, the highest cost is the fuel cost, the coke and PCI, and that depends on the raw material cost. But in practically, it is approximate comes to 40 to 45%. I am talking about the total DI pipe cost here. 40 to 45% is fuel-related cost. The iron ore cost was lower earlier, but going forward it is going up and up. Earlier it was on the single digit kind of thing, but today it will be approximate, say, again around 20 to 22%. So these are the measures. The remains are the small cost kind of thing.
Right. So thank you for all the elaborate answers. On the inventory front also, sir, is it on the DI pipe only that the inventories were not, the scheduled ones were not delivered because of the COVID factor? We see an increase in inventory for this quarter?
Yeah, Shubhro, you can answer.
So, on quarter-on-quarter, inventory quantity-wise has not gone up much. Pig iron, it has gone up marginally. DI pipe, it could have done better, but due to COVID in the customer side, it is marginally increased by maybe 1,000 tons. So very marginal numbers from that.
It looks a large number, sir, for this quarter. 22 crore is the change in inventory.
Yeah. But that is one of the reasons, Saket, that there are two things. One is that the price has also gone up. So inventory valuations has also got an impact. Because the raw material cost has gone up, therefore the inventory valuation has gone down. And on the pig iron, we have increased by, say, 25 to around 3,000. That itself is 10 crores. And BIP by 2,000, that itself comes to 7-8 crores.
Thank you. We will request the current participant to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Dhaval Doshi from Sundaram Mutual Fund. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Just a clarification on the post-merger synergy on iron ore. You said you are currently getting discounts, long-term discounts from procurement for Tata Steel. So post-merger, you said that you will get added cost. Is that understanding is correct?
No. So post-merger, we can get it from the mines of Tata Steel Long Products, which is a different entity. See, today when we are buying from Tata Steel's mines, it is a different arm's length pricing.
Right.
So still it is at a market price. Yes, because we are buying on a regular basis and we have a long-term contract, there is a long-term discount. So we get it marginally better than the market price. But when we are in part of Tata Steel Long Products, it's your own company. So the transfer of iron ore will happen at cost.
Okay. So, netted it's cheaper than what the current arrangement is. Am I understanding? Yeah, got it.
Obviously, when the iron ore prices, let's say tripled in Odisha over the last 1 year, our cost has also gone up 3 times. Maybe over 3 times you'll get some discount. Correct. But but your cost hasn't gone up 3 times, no? So if you get it from at cost, you get that big advantage. Of course, you can't get everything from that mine, but I'm just saying that Tata Steel Long Product has an iron ore mine. We can explore buying, rather, seeing the iron ore for our own usage from that same mine. Now, to what extent, it depends on quality, our requirement, etc. So we'll see all that, but generally speaking, that's another source which can be used.
Okay. And the entire, requirement will be from Tata Long mines only, right? Or you have to depend on the external source as well.
Yeah, I think we'll have to continue to depend on.
Your voice is breaking, sir.
Okay, I said the exact percentage we will have to work it out depending on our exact requirement. But currently, when we are not buying anything from Tata Steel Long Products, from that situation, we will be able to source a part of our supplies from Tata Steel Long Products, which will come at cost. And another part we can continue to take from Tata Steel, is how I would tend to think. We will cross the bridge when we come, but generally speaking, there will be an advantage of sourcing iron ore from your own mines, which are part of Tata Steel Long Products.
Got it. Thanks.
Yeah.
Thank you. The next question is from the line of 𝐦𝐤𝐤𝐤 from TCTL. Please go ahead.
Sir, thank you for the opportunity. My question is, when you source the hot metal, where do you source it from? And is it internal? When you say transfer pricing, right? I assume it is internal. When you go to increase DI capacity, how do you plan to get the hot metal for that?
So we had one last one. Yeah, sorry. You have another question?
Yeah, I had a follow-up as well. So on the pricing front, if you are sourcing it internally, and right now the spreads are lower, as you mentioned, because of the transfer pricing. So when you start using it, how does the capacity go up to 3? How does the top line go to 3,000 crores in that case?
So the hot metal is produced in the blast furnace. We have 2 blast furnaces. One blast furnace is dedicated to the ductile iron pipe business, and the second one is for making pig iron for sales. Okay? So both are internal, but these 2 are different divisions. They used to be different companies also once upon a time. One was a subsidiary of the other. So therefore, but we have continued with the transfer pricing policy so as to keep it at an arm's length and make sure that each business is competitive and stands out on its own. So that's one. So when we increase our capacity of ductile iron pipe, we will reduce our production of pig iron and divert that hot metal towards the ductile iron pipe new plant. Okay. So let's say, to give you more clarity, if we have a 6 lakh tons of hot metal capacity today, and let's say we are producing 2 lakh tons of ductile iron pipe, that means we have 4 lakh tons of excess capacity of hot metal. Out of this 4 lakhs, we can divert another 2 lakhs for making DI pipes in the second plant. So net, from 2 lakh tons DIP, we will become 4 lakh tons, and from 4 lakh tons pig iron, we will become 2 lakhs. Although I'm just giving the approximate numbers, 4 lakh is not a correct number, and we don't produce 6 lakh, we produce less than that. But I'm just giving you approximate numbers and aspirational numbers, which we hope to achieve. So that's just to explain to you how it works. As far as the top line is concerned, I mentioned that 1,000 crores of pig iron business and 1,000 crores of ductile iron pipe business. And we will add another 1,000 crore of ductile iron pipe, so that makes it 3,000. So today, pig iron is 50% of the business. Tomorrow, it will become 1/3 of the business. Does that give clarity to you?
Right. So what I understand is the pricing of pig iron and 2 DI pipes is 1:2.
It's not pricing. I'm saying the rupees crores turnover. Yeah. So you can, if you are taking 2 lakhs and 4 lakhs literally, then you're right. But actually, it's not 2 lakhs and 4 lakhs literally. Okay. So in fact, today the prices of pig iron, the net realizations are better than that for ductile iron pipe. So it's a bit of a, I would say, confusion here. So I think just to put it simply, the pig iron business is 50% today. It will become 1/3 after the expansion. Expansion, first phase is likely to be completed by end of this financial year. Second phase will be completed by FY23, second half of FY23. So by then we will have 1/3 of the total business as pig iron.
Sure, makes sense. Thank you.
Okay, right.
Thank you. The next question is from the line of Rajesh Majumdar from BNK Securities. Please go ahead.
Good evening, sir. Congratulations and thanks for taking the call. So I think my question is on the lines of the last question. In a way, I was actually wondering that on the merged entity of TSML with TML, what are we looking at in terms of the product profile, in terms of sponge iron, pig iron, DI pipes, and finished steel? While you have given us some outlook on the DI pipes, what is going to be, and pig iron also, what is going to be the overall combined entity, say 2 or 3 years out, in terms of volumes and captive integration of iron ore and coke with respect to the same?
Right. Sandeep Agarwal, are you there on the line? Sandeep?
Mr. Agarwal, we would request you to unmute yourself if muted from the handset.
I missed the question. Sorry, can you repeat?
Yeah. So basically, yeah. I was looking at combined entity of TSML and TSLP and TML with respect to the overall product profile, say 2 years out, in terms of pig iron, sponge iron, DI pipes, and finished steel. While we have some view of the DI pipe versus pig iron now, what would be the combined entity's overall size in terms of each of these things, with the captive integration on iron ore and coke thereof of the same?
So as of now, in terms of the, obviously, MD had just explained you in terms of the TML, but as far as the TSLP is concerned, over the next 7-8 years, we have aspiration to grow the long products business to about 10 billion ton. But as of now, there is no announced expansion plan for long products. So currently it is about 1 million ton. We look at adding to the EAFs, inorganic expansion, organic expansion over the next 8-9 years. Probably it will grow to about 6 to 7 million ton from compared to today about being about 1 million ton or so. So, but that will depend on that when the inorganic opportunities come, how they justify, we will need to see. As far as EAF is concerned, that would be more of the scrap-based feeded facility. So that will not be really linked to the iron ore mines being there or not. That's right. And as far as if whatever would be through the BF route, there also one can look at it that current mine obviously supports at about 1 million ton, and maybe some increase can happen. But if we need to look at more integration, we will need to see that there are two ways. One way is that obviously the new greenfield mines are getting auctioned and we look at it. Or other way is that currently the way the Tata Metaliks or Tata Sponge gets iron ore from Tata Steel on arm's length basis for long-term discount, that can be extended to.
And on the coke?
Coal, Tata Steel itself has about 25-30% integration. So the coal will continue to be on market, and the more important point is that as far as thermal coal, obviously India has thermal coal, but coking coal India doesn't have. So Indian steel players need to rely on the market for coking coal. So basically the overseas, Australia or maybe more of Pacific areas.
And the 1 million ton that TSLP is now producing, how much of that is sponge iron and how much of that is steel?
So 1 million ton which I talked about, DRI is a separate thing, and I talked about the 1 million ton of the long steel.
Okay, and how much is DRI production?
1 million ton produces about 0.7 million ton.
Okay. And so 1 plus 0.7, this entire iron ore requirement is currently captive, is available captive.
What is the 1 plus?
I'm saying for the sponge iron as well as the steel, the iron ore requirement is captive.
So probably this is turning TSLP call, but just to give you an idea that TSLP used to be Tata Sponge, which used to run only the sponge business, which has the facility in Joda. So that continues to buy iron ore from Tata Steel on arm's length basis, similar the way the TML does. Then sponge iron, Tata Sponge bought UML and we renamed the combined entity into TSLP. So TSLP currently has captive iron ore for the steel business. The DRI business continues to run on the Joda DRI business continues to run on the iron ore taken from the Tata Steel.
Got it, sir. And sir, if you look at
that makes more sense.
Right. So, and coming back to TML, if you look at the current EBITDA composition, a bulk of it is coming from pig iron. And since you are going to increase the capacity of DRI, which has a lower EBITDA per ton right now, over the years, this kind of profitability...
DRI capacity is going to increase?
Sorry, DI pipe capacity, DI pipe. I'm saying that we are increasing the DI pipe capacity and cutting down the pig iron sales over the next couple of years. And right now, the pig iron profitability is much higher than the DI pipe profitability. So will it be such that after all these changes we make, the overall profitability of the company will remain the same? I'm talking about TML now.
Back to.
So, the pig iron business is more of a commodity business. And today, because of the booming commodity prices, we are able to take advantage of that. And that's why you see the profitability of pig iron to be extremely high. Under normal circumstances, the EBITDA margins of pig iron business are much lower. assuming that assuming that it continues, we must differentiate and not look at the transfer price, but look at the DI pipe margins from raw material stage. And as I was telling you, that if you compare the EBITDA margins of DI pipe business and look at it from raw material stage, then you will find that even this quarter, the DI pipe EBITDA margin is more than 30%. So it is not that the DI pipe margin is lower than pig iron. What we should do is look at pig iron from raw material, what is the EBITDA margin, and compare that for DI pipe from iron ore to or raw material to the finished goods for DI pipe business. So the margins of DI pipe traditionally have shown come out with the number of 20% plus consistently, while pig iron has fluctuated. Even if we assume that pig iron continues to do well, the DI pipe will only go up from here, and it's already at a very, very high level. So there is, and it's a much more stable business. It's a business where the entry barriers are high. It's a business where we are seeing a tremendous growth opportunity. So therefore, there is all the more reasons for branching out into, or rather expanding your DI pipe portfolio.
May I add one more point on that? If we see that historically, the DI pipe margin will always be at least 8%, 7 to 8% percentage point higher than the PI margin, and that to a value-added product. So today the numbers are aberration because of the high pig iron, and as MD was explained, the transfer price. So the DI pipe profit is inclusive the PI profit. If we just do eliminate the transfer price profit, then the DI profit is also in the much more than the PI. And in normal circumstances, it is 7 to 8 percentage point higher than the PI business.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Shubham Agarwal from Equitas. Please go ahead.
Thank you for the opportunity. Sir, firstly on the DI business, I wanted to understand, given that you said the demand will be very strong over the next few years, what is the total industry capacity addition that is expected to come up in FY22 and 23, if you have that number?
I don't have it readily with me, but it's not that a large capacity is coming up. I think in FY22, Tata Metaliks capacity should increase by about 1 lakh to 1,20,000 tons. Other than that, there would be some minor increases here and there. I think 𝐥𝐸𝐤𝐿, and there is 𝐸𝐿𝐵, which is about 2-3 years time. So I don't think that will come in FY22. Who else? 𝐥𝐸𝐤𝐿 was expanding. Shubhro, do you remember who else?
It is mainly TML and 𝐥𝐸𝐤𝐿, which are the prominent players. Rashmi has are increasing the capacity, but their capacity utilization is very low. So it is mainly you have to consider the TML and 𝐥𝐸𝐤𝐿 by 1.2 plus 1 in FY22. And the new players, it will take time, say Welspun and all, at least 2.5 years.
Fair enough. So there will be a significant mismatch in demand and supply, it seems.
Only we have noticed that that Sathavahana Ispat, that plant which is closed for last maybe 3-4 years, now the date has been bought by 𝐥𝐸𝐤𝐿, and they may get started maybe 3 months to 6 months down the line. So that has got a limited capacity of 2 lakh tons.
2 lakh tons. Okay. Understood. And apart from this, any other inorganic acquisition of existing plant that we may look at, given you said a lot of the plants are not working currently?
So I meant Sathavahana only. It's not working. And then there are a couple of other plants which are at suboptimal capacity, and they've had problems of finances and profitability, and running these plants is not an easy job. As I have mentioned it repeatedly in the past also, the DI pipe business is a difficult business to do. Okay. And that's why you find very few players actually, doing well. Even Tata Metaliks, when it started with the loss and continued with the loss for a few years. So, other than Sathavahana, which is, of course, the capacity I have already included in the 2.4 million tons. So that's not beyond that. That's already included. The only two players what Subhro just mentioned who will expand their capacity is Tata Metaliks and Sathavahana this year. And we may see some more capacity additions like 𝐦𝐤𝐤𝐿 Iron Ore wants to expand, but that's a government company and they will also take at least 2-3 years. So nothing very significant going to come in FY22 and FY23 is my sense. There are players who may go in for some brownfield, a little bit of expansion, and we'll have to see how it comes. As of now, we don't find too many capacities announced. There is Welspun, there is 𝐦𝐤𝐤𝐿 Iron, there is Sathavahana, there is Tata Metaliks, and there could be a little bit here and there.
Right. And secondly, on the order book, so we currently have 14 months worth of order book, and you said that the realization is lower and that's why we are not taking in further orders. So I just wanted to understand what would be our blended realization for this 14-month order book currently.
So as I said last year, the prices were at, let's say, about 48 to 50,000 rupees.
Right.
So most of our orders are booked, which what we are executing are of last year.
Okay.
Okay. But as we have started booking every quarter, some quantities, the blended, prices, the realizations would start going up. But we'll see the effect of this more in the later part of the year and mostly in Q4 onwards. So we might see some of it in Q3, but mostly in Q4 onwards.
So it is fair to assume that 14 months worth of order book is booked at around 50,000 only.
Yeah, I mean, you can say so.
Okay.
Just for a sense, it's okay. Although numbers would vary from quarter to quarter, but on an average, you can say maybe another 50, 51, whatever.
Got it. And lastly, on the merger, sir, so continuing on the question of a previous participant, when it comes to iron ore utilization from long product. So, as I assume that the total capacity of 𝐦𝐤𝐤 mines is only 2.5 million, which is completely utilized by Tata Steel long product. So, do we have any surplus capacity of iron ore left in that mine, or the capacity can be increased there?
I will request Sandeep Agarwal to answer that question.
I would request, this is in Tata Metaliks call. Probably this is unfair to answer these questions at Tata Metaliks. We have said that when we talk about the synergies etc. closer to the date, then we will explain. Because
no problem.
Before commenting on that, TSLP has to make public disclosure on that.
Right. No problem, sir. Thank you and fair enough. That's it from my side.
Thank you. The next question is from the line of Shailesh Raja from B&K Securities. Please go on.
Yeah, thanks for the opportunity. So totally we have 40 months order book visibility in DI pipes. Can you give us rough regional-wise mix and which region you see stronger growth over the next 2 years? And with the capacity expansion, how our market share will improve from current level of 12%?
So with our expansion coming in, we are hoping to take our market share to, let's say, about 15% in the next 2 years. For us, the states which are showing strong signs of growth and projects are Odisha, UP, MP, Andhra Pradesh, Maharashtra, Jharkhand, and to some extent West Bengal. Of course, there are other states as well, Gujarat, Rajasthan, Kerala, Tamil Nadu also. But lesser than the earlier ones that I gave you.
Okay. Yeah. Also in the pig iron business, currently in 2Q, what is the realization you are getting in the domestic and overseas market for the foundry grade? In pig iron, what is our volume mix between foundry and steel grade pig iron?
So we sell roughly about, anywhere between 25 to 30,000 tons of pig iron, out of which, let's say 50-60% at least is foundry grade, maybe even more. The realizations of foundry grade, or the prices of foundry grade pig iron today vary between, let's say, 41,000 to 45,000, depending on the market to market.
Okay. So what is the realization difference, sir, in domestic and overseas market?
So overseas, the foundry grade, the prices are marginally lower, but the volumes are not there. What we have sold to China is mostly the steel grade, where the volumes are higher, and even though the steel grade prices are lower than foundry grade, it still makes sense because it still made sense to us because the demand was simply not there in Q1 of pig iron. As I mentioned at the beginning, that the foundry clusters were operating at 30 to 40% capacity. So either you had an option to produce foundry grade and keep stocks because you couldn't sell in the domestic market because it wasn't there, or you produce steel grade and export. Since the steel grade market was doing well, we were able to export, and that's how we could achieve record sales.
Good. Thanks, sir.
Yeah.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one now. As there are no further questions, I would now like to hand the conference over to Mr. 𝐤𝐤𝐤𝐻 from Monarch Networth Capital Limited for closing comments.
Yeah, thank you, Aisha. We want to thank the management for patiently answering all the questions. On behalf of Monarch Networth, we also want to thank all the participants for being on the call. Sandeep sir, do you want to give any closing comments?
Yeah, just I think one comment which I think there should be more clarity is that ductile iron pipe business is a long-term business. It's dependent on the water infrastructure investment by the government of India. Today, the focus of the government is heavily on the water infrastructure with the formation of the 𝐥𝐢𝐤𝐞 ministry by PM Modi a couple of years back, and with the announcement of the 𝐦𝐤𝐤𝐤 mission. And if you look at the figures of 𝐦𝐤𝐤𝐤 mission, both rural and urban, the investment by the government of India is to the tune of 100,000 crores. And there has to be, there will be many additions coming in from the states, from World Bank, Asian Development Bank. So there are a lot of funding agencies. So against investment of, let's say, about 25,000 crore every year, what we are looking at is almost 4 times the investment from government of India. What we have to see is how much of it actually happens. So we assume that even if the investment is, let's say, half of it, if it becomes 50 or 60,000 crore, we still look at a number which is twice or thrice the average yearly number of the last 4 or 5 years. Therefore, this is a great opportunity for the ductile iron pipe players to really expand their business, grow their business, and have sustainable good earnings for the next 5 to 7 years. That's where we see Tata Metaliks coming in with its expansion capacity coming on stream at the end of the year, the first phase and the second phase by next year, and positioned very, very well. We have positioned ourselves as a premium player, and that's where I think the major benefits of the ductile iron pipe business will come to us. As we grow in the ductile iron pipe business, to that extent, our pig iron business will grow, will reduce. But the advantage is that we will start selling only in the nearer geographies and not into the farther geographies. What it means is that even for the pig iron business, our realizations will improve, and therefore the EBITDA margins for pig iron business would also improve on a like-to-like basis. So on the whole, I see a very bright, positive, optimistic future for the Tata Metaliks business as it stands today. So that's the summary from our side. Thank you very much, all of you, for joining me and my colleagues, Subhro Sen Gupta and Sandeep Agarwal,